Nigeria's economy over the years has been grappling with high inflation rates hitting 22.41% recently. Well, however, retail investors' participation in the Nigerian equities market have been on a downward trend, which has been a source of concern to stakeholders. What are the levels of investors' confidence in Nigeria's stock market? Well, let's bring in a portfolio manager at AfriInvest Asset Management, Mr. Babajide Tolagbe. Mr. Babajide, thank you so much. It's good to have you on the program.
Thanks for having me. Hi, good afternoon.
Let's start from the local market, where we have seen excitement for some weeks since the takeoff of the new administration. What do you think, or how does this come to you regards to this positive review?
Yeah, thank you. So it is not actually coming as a surprise, from two standpoints. The first being that, in past time, we've seen instances when we have a new government being ushered in, and then we see some sort of participation in the capital market, which simply tells us that investors are, pretty much, excited about what is expected to come. I think we saw something like that in 2015's election and 2007 election, right, where the capital market, especially the Nigerian Stock Exchange, gained about 5% in the first 90 days that the government assumed office. So it is not quite new about the new interest we are seeing in the market. But I must mention that the difference, or what makes it completely the narrative difference, is that the new participation we are seeing in the Nigerian Stock Exchange market is largely on the back of the policies that the government has rolled out in the past few weeks, right? And these policies are they are designed to address the country's key major bottleneck that has affected how the Nigerian economy has sluggished over the last couple of years. As you can see, the Nigerian Stock Exchange, since the president's inauguration, the market has gained well over 8%, right? We've also seen interest in the Nigerian Eurobond market as well, where prices are also jumping as a result of investors' optimism. So these policies that are being dished out, investors are pricing it positively. A case in point is the removal of FX subsidy, right? And the interpretation to the market is that over the years, Nigeria has been expending a lot of its resources on providing subsidy for Nigerians, and some have even come to argue that in providing subsidy for Nigeria, the country has done the same thing for neighboring countries. So that simply tells us that over the years, the country has been expending materially to a particular portion that is not necessarily resourceful, right? And the complete removal of subsidy by this new administration has signaled to the general public that the country is getting back on track in terms of fiscal responsibility. The country is not going to spend money to areas that are not productive, and the funds that are saved from the subsidy removal will now be disposed towards infrastructure development within areas like education, health, and other manufacturing sectors. So this is a positive signal. This is what investors have been waiting for: how the government can begin to be responsible on how it expends money and free up some resources to be deployed to other productive areas. I must also mention that the removal of the unification of the FX rates across into a single market is also one important factor that is driving the optimism in the market, right? And I must also mention that over the years, foreign participation in the Nigerian equities markets was about 50 to 40% thereabout. But because of the FX illiquidity that the country has, experienced over the last, 5 to 7 years, that participation has declined, right? Last I checked, it declined to about 10 to 15%, which is basically telling us how poor investors see our FX market. And the major reason for the decline is because investors are not quite confident that they can easily take out their money. So there is not free mobility of capital to the capital market because of the exchange rate, different exchange rate market that we've seen in the time past, and because of the constraint that has been put by the previous government on how on exchange rate. So the removal of that particular stumbling block is bringing about more optimism that if we have a unified market where both investors, exporters can access FX rates, right? Liquidity will be provided for speculators to come into the Nigerian capital market and buy and sell at will, right? Which means they can buy at any point in time and they can take out their funds and take it back to their shores at any point in time. So these two major policies are the critical drivers that are championing the investors' positive confidence that we're seeing in the capital market as we speak.
Equities are net 1.67 trillion naira gains amid scramble for tier 1 bank shares. That was one of the headlines somewhere today. So why the drive for the bank shares? That's one question. Then I would also follow up with the fact that there is almost dead of new listings. How do we encourage good companies to come in?
Okay, for the first question about why we're seeing interest in the banking sector,
yes.
I must mention that over the last couple of months, the banking sector has been largely undervalued, right? And the banking sector, stocks have been undervalued because of the macroeconomic constraint that has affected the economy, and also some issues concerning the regulatory actions from the central bank that has affected the ability of the banks to operate efficiently or operate as they wish to operate. So significantly, that sector has been largely undervalued, and investors are not, there has been some level of apathy towards that sector, right? But with the, with the change of tides now that we're seeing in the economy and with these new policies that we're seeing, we believe that investors are cherry picking undervalued sectors, which is responsible for which is what is responsible for the interest we're seeing in the banking sector. And let's not also forget that the banking sector itself is at the heart of the economy, right? To a very large extent, the operations of the happenings in the economy have a significant impact on the banking sector. And we can now tell that since we are beginning to see new policies that are likely to drive inclusive growth over the medium to short term, investors are taking position in the banking stocks with the expectation that once there's a positive transformation in the economy, the banks are likely to perform better. And if that happens, they are able to enjoy capital appreciation over time and a strong dividend yield from the banking sector. So those are some of the factors that are largely responsible for the interest in the banking space. And I must also mention that we also have some sector-specific drivers in other sectors. Take, for example, the oil and gas. The oil and gas has also seen strong interest. Telecom sector has also seen strong interest. So what we can tell is that investors are strategically investing in these sectors that are likely to benefit from a much more better economy over the medium to long term.
But many people still avoid the stock market, of course, because of the fear of losses on investment values. You agree with me? Some companies are not paying better dividends, and that's worrisome. With a harsh economic situation, do we expect massive sell-off and exit by average investors at the moment?
So over the years, people have, to a large extent, people have avoided, participating in the equities market, and that is coming from the standpoint of, the risk, right? We all know the level of risk that comes with investing in equities, different from, the fixed income space where you have a guaranteed income. So, I mean, the level of risk in the Nigerian market has been largely responsible for that. And to just even break down that risk for us, we have the risk ranging from so many factors in, the macroeconomic space being the number one, risk concern, high inflation that is affecting how businesses operate in Nigeria, and as a result, is affecting their capacity to, earn, a decent, revenue or profitability, or deliver good numbers for investors. So, the harsh operating business environment has been a major deterrent to, seeing expansion in margins on, companies that are listed on the stock exchange. And if you're not seeing, a significant expansion in margin, it simply means that investors who are the down end of getting proceeds are not likely to see an expansion in their dividend yield over the time. But with the current, economic climate, I must say that on the short term, we might see some difficulties in the economy. Like we might see some short-term pains in the economy arising from these policies, right? And the case in point is the removal of fuel subsidy. The removal of fuel subsidy is going to pressure to a significant extent manufacturers and basically consumers, because this simply means more cost for, because businesses are likely going to pass on this cost to consumers. We've seen that in the past. So more cost for consumers, and slowing demand power, given the fact that inflation is shrinking and disposable income and all of that. So we believe that on the short term, right, we might see higher cost pressures due to the short term impact of these policies that are being rolled out, right? But equities, as we always advise, is a long term game, right? We expect that investors are buying into the future of these companies, and with these policies that are being ushered, if they are implemented properly, and the policies are being implemented and evaluated properly, we can and be rest assured that on the medium to long term, companies or businesses in Nigeria are likely going to excel. And if they excel, investors would also, get significant, traction in terms of dividend yield and as well as capital appreciation.
Interesting stuff, Babajide. Globally, markets are not very attractive, if you agree with me, especially after COVID-19 and now the war in Ukraine. And now, is the world not heading towards global, is it recession or poverty?
Maybe not in terms of heading towards global poverty. Maybe not. But in terms of heading into a global recession, I mean, there are talks of we're likely to see a global recession in 2023, and this is the reasons are not necessarily far-fetched, right? Let's not forget that when COVID came in 2020, governments and monetary authorities had to usher in some sort of palliative and support to support businesses and individuals. So that brought about a level of surplus cash in the system. Investors could, make demands here and there, and businesses could also borrow money at a cheap cost. We saw hiring spree during that period. So there was a lot of, funds in the system, and businesses were, working at optimal capacity. And as a result, we also saw inflation trend higher in 2020, 2021. But if you notice from 2021, when inflation hit the roof in many of these advanced economies, we saw central banks trying to increase interest rates so they can mop up the available cash in the system, so that consumers are not able to demand as high. And I mean, the primary reason for increasing interest rates in these climes is just to reduce the level of inflation. And the case in point is in the US, inflation went to as high as 9.1% in 2022. So the central bank had to increase interest rate almost 10 times, from about 1.5% to currently is at 5% thereabout. So that increase in interest rate is bad for asset prices, and that is why prices of global assets have been declining. So I can agree with you that to a significant extent, the global market is not necessarily attractive at the moment, and it is on the back of policy normalization in advanced economy and recession worry. But in terms of outlook, we are getting towards the point where inflation has peaked in most economies, and in some large economies like the US and in Europe, we're seeing inflation already going down the hole, right? Currently, it's around 4%, and about 6 to 7 months ago, it was around 9%. So inflation is already moderating in those climes. Central banks are now beginning to rethink their monetary policy discussion. Many of them have even, halted, the rate hikes, and we are looking at a possible rates reduction in the next 6 to 7 months. So the last 12 months has not been really, really rosy for global markets, but I can see that the next 12 months we're already seeing the foundation for a positive global market play in the near term.
So moving on, in the year, what is your outlook? Well, locally and of course globally, in 1 minute.
Let me start with globally because to a very large extent it trickles down into
Of
locally
course.
as well. So for the on the global front, in terms of global output, and speaking of growth, we expect growth to be to be mild, to be weak because of the impact of policy normalization on all these respective economies. But in terms of the capital markets globally, for equities are is likely to outperform other traditional markets because of the interest we've seen in that space. I mean, as banks begin to halt the increase in interest rates, it simply means that borrowing costs in advanced economies will not necessarily go higher. And if borrowing cost is not necessarily going higher, companies can take funds to deploy into productive areas and deliver good return. In terms of fixed income, I think that given that inflation has peaked and is already moderating, we're likely to see a moderation in global yield over the second half of the year. Let's just bring it back to the local space as well. I mean, you can already see that the equities market is currently in a state of roller coaster, right? And to a significant point, we think that performance will be sustained towards the end of the year as we begin to see more pro-market policies being disposed by the current administration, right? But it is also worthy of note that we might see some downside risk, right? Risk rising from higher cost pressures, which may affect the profitability of major companies in Nigeria. Risks from energy, removal of energy subsidy, for subsidy, and the impact of the devaluation on the cost profile of these companies. So the downside risk is that we might see some shocks in terms of supply shocks that may raise prices high, and the margins might not be necessarily great. For the fixed income space, that market has been largely unpredictable because of the forces of demand and supply and some other factors that are affecting that space. But fundamentally, we expect yield to go high because we are currently in a period of policy tightening. I beg your pardon, policy tightening, because inflation is jumping, and we need to curb that path, right? So we think that fundamentally yields are likely to continue to go high, but we cannot take out the unfundamental factor, quote unquote, because those factors are also playing or giving us a significant headway in terms of market performance. So for the fixed income space, we still think that we are likely to see yield or interest rates remain at this current level, till the end of the year.
I must thank you so much for your time. Interesting conversation, Mr. Babajide Atolagbe. There is a portfolio manager, Afri Invest Assets Management. Thank you so much for your time.